There's a big news today in Washington, as well as on the economic front, as well as overseas, with multiple central banks announcing their policy decisions. So lots to break down, how that all impacts the market situation, as well as I break down all these technical signs of weakness that are starting to crop up, suggesting that this near-term volatility might start to increase, intermediate run might start to end. So I'm going to show you all that, as well as a trade idea from a sector that kind of kept the market from being worse than it was. Let's go ahead and get started. My name is David Settle. This is my market outlook for today, Thursday, December the 14th, 2017. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Subscribe to my YouTube channel. Hit that red subscribe button that's right down there below the video. Also, hit that thumbs up that's right down there too. That lets me know that you liked it today, that you want me to keep doing it again tomorrow. Scroll down further and comment on anything that stood out to you in today's video. I'd love to see what you're learning, what stands out to you. Finally, in that video description, there's a few links for you, including one to subscribe to my daily email newsletter for the Market Outlook. You can do that down there at the bottom. Remember to follow me on Twitter for more content in addition to these videos throughout the day. You also see tonight's Market Outlook tweet there. Like and retweet it from there. And finally, join the Market Outlook community on Facebook. The address is at the top of the screen. I'd love to have you come join the hundreds of people that are following and watching these videos day after day. Well, let's take a look at the S&P 500 first then with the market forecast indicator and see what we got going on. Bigger pullback than what we've had here lately. Now, we've had, a pullback there. We had a big candle like this, at the beginning of the month, but the difference there is we gapped up and came down throughout the day and actually finished with just a small close. Today, it wasn't a half a percentage point, but we just don't get full percentage point drops in the S&P these days. It's very rare to close that far. You can see we were sharply lower there, but rallied. The buy the dippers never came in today. It's more of a slow, gradual move. But you see what it did from the market forecast perspective. Still a strong bullish posture, so keep that in mind. We're not looking for significant bearish move yet. The near-term line still actually in the position for a bullish low point, because the last near-term low is right there. This would be if we bounced here, it'd be a low in between 20 and 50. It would be a higher low point, and it would be, Fibonacci support in this 38 to 50% area. So, we'd actually be fine. There's nothing significant here. Now, you notice we only had, 1, 2, 3, 4 days of the near-term line above 50. And we talked about that before, right? We said we don't expect the near-term line to make a 7 to 12-day run here. And if it did get up to new highs, it wouldn't be very big, and we did go up a little bit higher. But we're going to start to get more ups and downs while these longer-term moving averages catches up to price. We won't necessarily drop significantly down. Of course, anything can happen. This tax reform bill doesn't get passed for whatever reason. There's a lot of tax reform positivity here over this past little bit that's really pushed the market up higher. So, if that doesn't get passed, like any kind of news event can throw anything off, technical analysis wise. But just barring any change in anything that's expected, right? Because that's what technical analysis always prices in, what's expected. That's why it doesn't like what's unexpected. The market doesn't like the unexpected. It likes to be able to price in expectations. So here's the expectations, and you can see, we're pulling back right now. It's a normal pullback. It didn't last very long, but we didn't expect it to last very long. Just like we don't expect this pullback to last very long either. It might come down. It might even come down to this 2630 area for all we know. But I don't think that we'll start a new significant long-term bearish move anytime soon. Not with market sentiment as high as it is. Still very strongly bullish. And then even, like I said, the intermediate line still easily in the upper reversal zone. When you take a look at the Dow Jones Industrial Average, a little bit of a cluster going on here, same thing. And same thing we saw in the S&P, extreme low on the momentum line. That's a signal to a change in trend. Now remember, strong bullish trends, what does it change to? It changes to weak bearish trends. So we don't ever get a strong bearish posture, strong bullish posture changing to a strong bearish posture. Never makes that change. Only goes from strong to weak. And then weak back to strong, just like that. So yes, the momentum line suggests there's going to be a trend change here and a posture change coming up. Right now, the current posture is strongly bullish, so we expect it to change to weakly bearish. And the key point there is weakly bearish, not the kind of trend that would tell us to sell off all that we own and go to cash, not the kind of posture that would say, load up on buying puts. It's the kind of posture that would say, let's take some risk off the table and still maintain this bullish long-term trend that we're seeing on that market sentiment. If we take a look at the NASDAQ composite, not as strong a drop on the momentum line, but again, you can see how the near-term line just didn't spend very much time up above 50, and the Russell 2000 is the worst out of all. It dropped a full percentage point. Its near-term line only spent a couple of days above 50, forming a bearish high point. We're now forming potentially lower lows, still holding the long lower shadow here for a support level at 1500. You break 1500 now, we're looking at a deeper move, and this kind of suggests weakness, and we've talked about that before, that we're just not that bullish as what the market forecast would say we should be, simply because we've been bullish for the 4 months. And the other reason is the Russell 2000 just isn't cooperating. And you would want, when you're the most bullish, Russell 2000 should be outpacing. Small cap stocks should be outpacing large cap stocks. When you are bullish but with an asterisk, that's when large cap stocks is outpacing small caps. That's when people are saying, okay, we're going to start rotating into different areas that keep pushing the market higher, but make sure that we're rotating into safer areas in case of a pullback, that we don't lose our shirts on these high momentum stocks. We're going to move out of those and move into these safer stocks that might hold their value stocks in particular, or income stocks that can hold their value better. All right, so the long-term charts, one interesting little development here is this long upper shadow developing potentially. Now, granted, we have another day left in the week, so keep that in mind, but long upper shadows are not bullish. You can see when you're rising, you don't get long upper shadows. Usually we close Friday at the high of the week. Not always, right? But when you're bullish, that's a typical pattern. Now granted, they're not going to be long upper shadows, right, compared to long lower shadows, because the volatility index will be a lot higher and you'll get much bigger long lower shadows. So you can see it doesn't take much of a longer upper shadow to cause some bearishness. So we'll definitely keep an eye on that and see if we close higher on Friday and fill in some of that, or if we close lower tomorrow and finish with that, then that will obviously be at least a short-term bearish sign. Because again, I hope when I'm suggesting a pullback, that everyone's thinking, okay, and then the market, David's saying the market's gonna really tank, because I don't want to get lumped in this kind of, the market's just got to tank kind of a crowd. Now, granted, fundamentals would suggest that we're overextended right now, but I also know that the market's based on human psychology, and it's not always based on fundamentals. And so as long as humans can be irrational, then the market can be irrational. So I don't, in technical analysis, the best way to see through that irrationality, because it tells it like it is. All right, technical analysis tells it like it is. It's that. That old Minnesota Vikings head coach, famous for his rant on TV, said, they were who we thought they were. Well, the market is what we think it is, because of what the action says, no matter what we think it should be. All right. So if you take a look at the 3 green arrow chart, you can see that we have, again, as significant as today's pullback may have seemed, as bearish as it may have seemed, again, we're still above the 8-day moving average. And that 8-day moving average is still well above the 17. And now, granted, there's divergences setting up here. And the low of the divergence would be at 26.25. But you see, even that wouldn't even be a 23% Fibonacci retracement of this intermediate run that we've been on since the middle of August, when we rallied. This run that we've been on, these multiple legs, still wouldn't even get us down to that divergence. So Now, granted, move down to 25.75 is more likely in an intermediate pullback. They'll probably get the intermediate line to show a bearish posture. It might even bring the market sentiment line down to say 70 or 80. And and it's a 100-point drop, and the market would go crazy if that happened. But you wouldn't, because you would know, okay, that's just a little bit of a pullback. There's going to be support in that area, and there's going to be an opportunity for us to bounce and continue on a bullish trend, or at least go up and down, right, in between those 100 points for a while, and let the market kind of shake out and pause and reset itself, so to speak. Today's intraday chart does look a lot more bearish than we've seen. You can see the high of the day was early, the low of the day was at the end of the day. In fact, we touched it a couple of times in the afternoon. So lower high, lower low, closing well below yesterday's low point, closing back inside of last week's range. We had been trading up above last week's range, so we had moved up that 4-week range, that 4-week high from over here. We moved it up Tuesday. We moved up again a little bit yesterday, but not today. Lower high today, and then obviously a lower low. So you can take a look. We have moved the low end of that 4-week range up. So it was down here. Now it's up here. And we talked about, it's a 10-point difference now between, and pretty soon, we'll move it up over the next few trading sessions up to 259, then eventually up to this 260.5. So now it's going to, you can see how the range is starting to tighten, and eventually we'll get up to this 262, and which will only have about a 4-point range at that point. So barring any moves to the upside, you can kind of see how the range will start to tighten up here. But as of right now, we're still easily in the upper half of the range, so nothing to be concerned with from a bearish standpoint. You can see where there's going to be some obvious support on an intraday basis around that 263 level, which actually the midpoint of the range is going to still be right about in this 262 area. And this area here will be the midpoint of that range. As it moves higher, it will move up into this 263, 260.5. That will in the next few days, that will end up being the midpoint of the 4-week range. So as long as we're trading inside of that bullish moves range that we had here, we're fine. We break 263, we're not going to be super bearish at that point because we'll still be in the 4-week range. But that's when you'll start to say, okay, we're not, now things are going to start to build, from a weak bearish posture. We'll start, which will probably get us to this point. Well, then if we break it, start to be more of a stronger bearish posture, getting the intermediate line below 50. Once it gets below 50, it's like buying opportunity. Now, not that day, but eventually, right? So that's why we look at any drops in the intermediate line below 50 as buying opportunity eventually, and we'll keep our eyes peeled and see, because again, the range will come down to a low point. You'll hit the 4-week low, and you'll have a big range to the downside, and you'll come off of that. So you'll with high volatility. So that's when we'll keep an eye on, watch for close above the high of the low day. Those kind of signs that we're forming that bottom. As of right now, we're still in very weak pullback mode. If you take a look at the range today and the volume, pull that up here. You can see the range today was over 1.5 points, 1.62 points. The volume, again, close to 100 million shares. Yeah, the volume's rising. So you put that in context here, 100 million shares is up, 90 million shares is up here. So we're still moving that higher and higher. The range also is a little bit above average too. So we're getting kind of these bearish, that's a bearish range. It's granted, it was a close lower today, but that type of range and that type of volume is not bullish. We want to be slow and steady and grinding to the upside. You get moves like today, with these picks up, with these picking up in volume and trading ranges, then that's just going to lead to more pullback. But again, more pullback to 257.5 would not be a bad thing at all. In fact, that would kind of be a normal thing. That would be a normal kind of exhale, so to speak, coming after a pretty decently long inhale. And you can make all sorts of jokes out of that as you deem fit. This kind of shows too, again, how, again, strong bullish postures turn into weak bearish postures, because as we're rising, we're still only at 10.5. Still would be, if we rolled over from here, a lower peak on volatility. So things are turning down. We're having a weak little pullback, but it's nothing more than that. So don't buy, even if we pull back down, another day or two, it's nothing more than that as of right now. If we take a look at the volatility index here on a relative basis, you can see again, we're still, the sweet spot for a bullish trend is when the volatility index is in that 85% level. We're still at 82%. So we're still easily in the bullish range of where volatility is now compared to, or at least in the next 30 days, compared to the next to the full 3 months. So, weak pullback, as of right now, nothing more than that. All right, now let's transition into what's driving the price action today. And again, a reminder to follow me on Twitter. Again, there's my address, twitter.com/DavidSettle42 or @DavidSettle42 if you're searching for me there. You'll see a follow button right there. Just click on that follow button. You can see my timeline. Always has tonight's market outlook tweet pinned to the top. Make sure you like and retweet that, because the more that you engage with my tweets, the more Twitter will keep pushing you my tweets, including all the other stuff that I put out there throughout the day. And we talked before about the key to success in trading is cutting losses, small losses, reiterating that point. And again, last night, really great feedback to Brandon being on. We had a ton of thumbs ups on the video and a lot of views and a lot of great comments. This is the word cloud from the comments, so a common theme that it's great to have him back, and it definitely is. And so Brandon and I will continue. We're working really hard. There's a lot of family time right now in the holiday season, but in the midst of all of that, we're working really hard to get something built for you all coming into the next year in the 2018 that we think you'll really love and benefit from, and new education companies. So lots of things. Things are moving positive again. We're moving in the right direction. So stay tuned for more on that. In terms of what's driving the action, the news-wise, there's a lot of news today, mainly coming out of the other central banks. And remember, these other central banks, the Bank of England, the ECB's rates are still at 0. The Bank of England just barely raised rates for the first time to 50 basis points. But they're still in QE mode. Both of them are still in QE mode. ECB is just starting to taper. For next year, starting to taper. Remember, we tapered our QE in 2014. So they're just starting to taper. We started raising rates over a year ago. 2 years ago, I believe, in December. So, so we're well further along than they are in their path. So that's why, the dollar had a down day yesterday, a brief little dip. But don't read a whole lot into that, because it's all relative. Yeah, the Fed may have been seen to be a little dovish yesterday, and we even saw that in the see that going on right now in the interest rate hike expectations. You can see the odds. So here, we're at 125, 150 right now. This is the odds for March. You can see the odds of getting another rate hike by March was up to almost 60%. But that dropped significantly in the last couple of days, and the odds of holding here where we're currently at by March rose. And you can see for June, again, we're at 125, 150. That's the purple line. It rose. The fact that we won't get one by June even, but still at 20%, so still low probability. This one, the gray line, was getting a rate hike in March and a rate hike in June. And it was rising up to 40%. In fact, it was almost as high as only getting one by next June. So the markets, the Fed's putting on the brakes a little bit. Tapping the brakes on these rate hike expectations, which are really starting to rally. And you see, so we saw that yesterday in the dollar pullback. But again, remember, while that was bearish for the dollar in and of itself, compared to what other central banks are doing, the Fed is still much more restrictive. Much better said, much less accommodative. Not really restrictive, but much less accommodative than where. And so that's going to help the dollar be a little bit stronger. Now, when you take a look at other things that are on the news, on the calendar, you can see that it was mainly import-export prices, holding up pretty strong, similar to what we saw earlier this year. You also see retail sales was the biggest news. Came in very strong at 1%, 1% growth here. back over here. That kind of jumped on me. There we go. 1% growth. And when you take out gasoline and autos, still at 0.8% growth. So very, very strong retail sales, because that was, you can see gasoline sales were up. Autos were down a little bit, but gasoline sales were up pretty strong. So year over year, the headline figure, including gasoline and autos, is higher than it's been for a long time since QE3 ended. So very, very strong retail sales report, leading to a very high 74. I mean, we haven't had this high of an economic surprise index since the end of 2011, beginning of 2012. Now, things got a little dire in 2012, and that led to, we were coming off of the credit downgrade. We got Operation Twist that pushed things back up. And then we pulled down and we started QE3 at the end of 2012 to offset that. So, we haven't been this bullish since coming off of, since 2011, when we were close to over 80, almost 90. And we don't stay up at these really, really high levels for very long. You can see when we get to these high levels, we come down pretty sharply. So keep an eye on that. It's going to be hard to sustain beating the estimates all the time. But with today's report, GDP estimates also rose above 3% again, 3.3%. So so far for 2017, so good in terms of economic growth rising. Remember, inflation's rising too. We saw that in yesterday's calendar with the CPI, and we saw it with the PPI especially. But with the CPI, you can see the year-over-year rates above 2%. Core is still down, but the year-over-year rates growing from being at 1.5% to being back at 2%. So, again, 2% economic growth will just basically match inflation. There's not a whole lot of real growth there. But, at least it's better than what we had been seeing from an economic growth front. And we're starting to get some pickup here. From an asset class standpoint today, again, more of a down day, so stocks are down. You can see small caps were down the most. Emerging markets, international stocks kind of matching each other. There's the S&P 500. High yield came down along with these large cap stocks. You can see gold still finished down, so a little bit of strength in the dollar, a rebound in the dollar there, and long-term bonds rallied too. Again, more of a risk-off move. Crude oil started down, but then rallied throughout the day and finished with a pretty good gain. You can see, it had been dropping, had dropped sharply in the last couple of days. Here, right there we go. Had dropped sharply down 2 3/4% at today's open, but bouncing back up. And you can see, last few days, bonds and gold, kind of a safety move right now. And assets are moving towards safe havens, not the dollar. You can see the dollar's kind of down, up a little bit today, but down mostly. But into bonds and into gold, just slightly into gold. The sector rotation this is from the FOMC meeting. So once their decision was announced, you can see the financial sector did not like it. So this idea that, and you saw those rate hike expectations starting to pull back. They had been really starting to ramp up for 2018 with March and the second one with June. And we saw how they turned around in the impact that's had on the financial sector. You can see that in fact, the only two sectors that have gained since the Fed meeting has been the consumer discretionary area, which is buoyed by, merger acquisition news, Disney with Fox and things like that. And you also see consumer staples, which had a good run at the end of yesterday. But healthcare, on the other hand, another safe haven area, also had a good run yesterday, not holding up today. In fact, pulling down and finishing much lower. In fact, materials, which was also kind of a winner by the end of yesterday, along with industrials. There's your industrials, healthcare, materials. So the big winners yesterday all pulling back. Even staples was just matching the market's loss today, whereas discretionary held its value better than anyone. You had this technology kind of holding up too, and real estate and utilities benefiting from the drop in yields, so they outperformed the market. But it's it was kind of a very select few stocks, kind of especially large cap stocks, holding the market up from what we saw at the with the Russell 2000 ended up being a full percent, more than a percentage point drop. So we didn't get that big of a drop like we did in the materials and healthcare sectors because of some bigger names in the technology and discretionary space. All right, one of the big names in this space, in that discretionary space, Tiffany, you can see here, broke out today on pretty decent volume. So 3 green arrows and decent volume. We had 3 green arrows with decent volume back here. You can see not quite, a little bit more than 1.5 times the average volume there. Stochastics had turned up, green arrows on the moving average, sideways trend, so you need the spike in volume. You can see it followed through with that with another spike in volume and 3 green arrows. Breaking up to new highs, and we kind of meandered around. Then today's breakout here, kind of helping solidify, breaking out of Bollinger Bands. You can see it's breaking out of the upper Bollinger Band. Long upper shadows, so not the most bullish when you see long upper shadows like that, but at least showing some positive signs here. This was a trade I've talked about before a long time ago, and so did Brandon, when it was down to $60 at a yield that it doesn't normally get to. So really good yield. Remember, you get the yield at the price you bought. So as the yield drops, the price rises to 90 some odd dollars now. So 50% return on that. That yield stays because of the cost of where you bought it. So you still end up getting decent yields as it continues to trend higher. So, but we're not in this environment right now where you want to say, okay, are we going to get another 50% move? Highly unlikely, at least from today going forward, for the short term. So instead of being so strongly bullish, again, we're buying stocks is pretty much what you got to do. Options provide the opportunity to be temporarily bullish and dial back the risk a little bit. And so instead of buying the stock, we'll sell a put. We'll sell that 96 put at that 43 days out. You can see right there, the spreads are going to be a little big, so you're going to have to fiddle around with the spreads to get filled in and see where you want to get in at. Ideally, you want to get in around 47 cents or higher, because that's a 30% return on risk. And you notice, as long as you're, let's pull up Tiffany here. As long as you get that kind of a return, you'll have a decent odds of success. Your break-even point is going to be down here below, this at this $95 area, which is fine. That's where you want it to be. And you can see that if we let it go down to 95 and break through that, then my loss is going to be about 49 bucks. As long as I'm above, this level, this area here, as long as we're trading in this area, time decay is going to work for me. Once we get past this intersection, time decay is going to start working against me. And you notice, no matter when I hit that price, my loss is going to be about 50 bucks. Well, that's what my gain is. So I'm always going to have a 1-to-1 reward to risk ratio as long as I get out when we hit, when we start dropping below 95. So I wanted to bring up this idea. So it's a high probability trade, good bullish trade, but a way to not be so bullish. So you can see my delta is really small. I'm not looking, no, my delta is even smaller. Actually, you know what? There it is. 7.5. So very small delta compared to 100 if I bought 100 shares. So if the stock goes down $1, I'm not going to lose 100 bucks if I own those 100 shares. I'm only going to lose 7.5 bucks. And again, I'm going to have time decay working for me, whereas if I buy 100 shares, I don't have time decay doing anything. So I've got a decent odds of success, decent reward to risk ratio. I wanted to talk about this idea of selling a put way in the money and why the danger of doing that, and why I always say go for that 1-to-1 reward to risk ratio when you get to that intersection. So I set up a trade here on SPY, going way deep out of the money to sell a high probability put, 90% odds of success. Very popular strategy to sell way out of the money puts. The problem with this is you can see my strike price is at 254. So as long as we're above 254, it's almost like, whoops, where is it? Which is the one I want? I want this one. As long as we're above 254, which is way down here, it's almost like, the frog in the boiling water. The water's not boiling yet, so there's nothing to do, and you think you're fine because you've got time decay working for you, right? And so you think you've got high probability, we're fine. But once you get to this level where that line crosses now, instead of being a 1-to-1 reward to risk ratio at 13 bucks, now I'm at a $60 loss. So remember how we said before when we set up the normal, let's look at Tiffany again. We're going 48 bucks for 100, so about a 1-to-3 reward to risk ratio. So if I take a maximum loss, I've got to have 3 maximum gains in a row to offset that, which is low probability to get that, just to break even. So you can see why we just don't want to take maximum losses. So that's why we get out here and take a small loss. Again, key, cut losses, cut losses, cut losses. We'll go back to that high probability strategy. Well, as long as we're above 254, we're fine because it's way on down there. And again, the water, it's getting warmer, but it's not boiling. Well, once you cross that midsection, it's starting to boil. And it's like, okay, well, now there's nothing we can do. We can't get out because at that point, we're down to a $60 loss compared to a $13 gain. That's even worse than a 1-to-3. That's like a 1-to-5 reward to risk ratio, which means now I got to have 5 of these in a row go for me just to get back to break even. So, but we don't, we usually think, okay, well, I'm not going to, we've gone down so much, we got to go back up. It was high probability to begin with. And so we think, we're not going to get out that $60 loss because that's a horrible reward to risk ratio. And we let it keep going, and we end up taking a $187 loss for a $13 gain. Now we end up having to make a lot of maximum gains to offset that. And that's why that strategy of selling deep out of the money isn't, because and it's mainly just because, not because of odds, but it's because of our psychology. It's much harder to avoid big losses when you're trading that strategy than this one, where you can say, okay, well, I'm going for 48 bucks. If I get to this point, I'll take a $50 loss, 1-to-1, fine. And a high probability, we're fine for that. So that's why that 30% reward to risk ratio is a kind of a sweet spot to look for, because it sets that up where the crossover point here, where time decay works for us versus against us, ends up being that 1-to-1 ratio. My break even is going to always be above it, typically. So we'll be at that break even level. So we'll have a high probability of staying above it. But if we were to cross it, then I'm going to still take a pretty small loss, relatively speaking. And I can offset that loss with only one trade, one max gain, which is a high probability trade. But 3 in a row, not so high probability anymore. So to summarize, the market remains in a strong bullish posture. The long-term trend, very bullish long-term trend, still intact. We are showing some signs of weakness. There are some technical factors, and I point out what they are, that suggest we're going to get, a near-term pullback right now, and we're going to get some near-term volatility. Nothing yet, though, to suggest any more than just a weak pullback. Weak enough that we're not going bullish anymore, but also not bearish enough that we're just going to hang around and let those long-term moving averages catch up and let that high MACD pull back down to 0. There's things that have to really get kind of stale and boring. There might be some ups and downs, but no clear directional trend until things go more sideways, we get closer to some of these moving averages. All right, so with that said, thank you very much for watching tonight. Remember to subscribe, like, and comment down on the YouTube video down below. We got a lot of comments yesterday welcoming Brandon back. Keep up the comments, and we appreciate the engagement. Also, remember to follow me on Twitter, like and retweet my tweets. The Market Outlook tweet from there, always pinned to the top of my timeline. And finally, if you haven't yet, join our Market Outlook Facebook community with the address that's down in the description below. Have a great evening, everybody. We'll see you all tomorrow.